beautiful and honorable woman, and you male folk too, that make up that majority. Great to be back with you. And, oh, wow, never thought I would be doing this. It was like the day would never come. What is he talking about? What is he talking about? The Dow Jones Industrial Index. Wow, let's take you on a little journey from 2007, prior to the subprime crisis, he says, as he glances down at his chart on the laptop. That's where I'm looking, in case you're wondering. Going to the weekly chart, in fact. This is big time frames. What are we talking about today? I'm going to tell you. What has actually happened is we are seeing what I am now going to call the crash. Not the crash that goes to zero crash, but a very, very big one. And it's going to be the biggest one we've had on the Dow, in my view. That doesn't mean you can't get plunge protection team tomorrow. A little bit of economic engineering by the control structure. It's always going to be there around. But looking at the chart, let me just say this to you, and I will do a technical take as well. That the 2007 highs were roughly 14,168. 14,168. In fact, 2018, we have sped along swimmingly, one may add, swimmingly, like a dolphin, very expediently and abruptly, despite our absolutely crippled by a debt economy, and in fact supported by that very same debt economy, where margin on brokerage accounts have been at all-time highs. Everything has been buildy-uppy, lend, reinflate, never dealt with 2007-8 issues, just pump it up again. Because we've added some rules and some various security regulation and scams, we're now going to prevent banks from doing what they've always done. And in fact, what they've done is they reinflated the Dow. They reinflated property to a degree, but they've not managed it to the same extent. Stocks, buy stocks. I'm talking particularly the US. 26,656 is this chart's high just recently. Then we had a little sell down, and then we had a little rally. And what actually happened, and this is the value, I am both the reset sniper, telling you about the control structure and the great game that they play, fascinated by it. But most importantly, I am the market sniper, which is the founding holding body for the HVF method. And this means instead of being emotional, you are method driven. In the absence of method, you are emotionally driven. What's actually happened today is we've got, and this is going to sound a little weird and it might not mean anything to you, and I'll tell you what I'm predicting on the back of it. But first I have to explain what the method has said. And some of you go, oh, boring. Are we crashing? Yeah, woohoo, jump on short. No, you need a method. Because you don't know when to take off. You need a target. You need to know where stop loss is, because we can still always be wrong. It's a probability thing. It's never a guarantee thing. But what's actually happened is we've got our first very good, and I'm talking very good, aka beauty queen, luscious HVF, mouth-wateringly good she be. Maybe it's got to be a she. It's a first one in a new trend. And the interesting thing about that and our methodology, and you'll learn a whole bunch more in HVF method program, is that first setups in new trends overperform. In other words, instead of just making a target, they continue to capitulate. There is a first momentum. There is all the money committed on the long side, aka buyers, that suddenly has to panic out. Instead of and there's nobody new in the buying pyramid. The Ponzi scheme has got too broad a base now. There's no new money coming in, and all the people on the apex points want to come back out. And that, ladies and gentlemen, is a problem, because it means absence of buyers and huge disproportionate wall of sellers. And then let's sprinkle in a little bit of leverage, a little bit of banker juice. That means the man with the 10 grand account has been trading 100 grand pot. Now that becomes ever so much more interesting. It's been real good for Mr. 10 grand geared up to 100 grand, because every time the market doubled, which when you go from roughly 14 in 2007 highs, and in fact, let's talk about the lows of 2009, March 2009, 6,473. Blood in the streets then. Nobody wanted a share for love nor money. All the money had escaped. Lots of money on the sidelines and real cheap stocks. 6,473, the world's going to end, we're all going to die mentality, and that is your sentiment index. And from 6,473, we've scurried past 26,473. We've added an extra 20,000 points plus. And what's actually happened in that, more than tripling, in fact, more than quadrupling. Let's just say that again. A very mature, established index that probably has an average on the low single, moderate low single digits, 6-7% a year average, has gone from 6,473 to 26,000 in the period of 2009 to 2016. In other words, you are talking 2016, 2018, my apologies, 9 years, and you've gone up well over 4 times, 4 1/3 times at the high from the low. Now, as we stand now at 24,000, I am calling for this to fall well down. Now, the problem with the first setup in a new trend is our target that is typical of 22,000 is going to be overshot, and we don't have a method for how. We have a method for how to take ourselves out, and we call them the overperformance bands, and you can learn about that on an HVF program. But we don't know how far it can go. We called oil short at $104 on the exact same methodology, and we had upper 70s target, but it fell well through that, and we had overperformance bands. We thought surely it's not going to go much further than $60, and we panicked and we closed. We closed way too soon. The oil market, traded lower than the previous Great Depression low. That was 2008. Yes, it's a depression. And actually traded at $1.26, $25, $26, depending on whether you were looking at Western Texas Intermediate or Brent. And that was a similar setup. In other words, it may defy your belief system how far it performs to the downside. Think of all that unwinding leverage. This could even trigger bank failures as over-leveraged hedge funds that have been net longs, over-leveraged retail traders with brokers can't meet their requirements, are forced closures. You see, even if you knew, as many people felt they knew at the lows of 2009, it couldn't get cheaper and it could only go up. They couldn't hold on. Why? Because their bosses on the desk were saying, you're losing money, and you've been losing money for 2 years. It's time to close that position or you lose your job. And that, unfortunately, means forced seller. That doesn't mean that people don't understand it's not a good time to sell. They have no other option. You've borrowed money from a bank and they are calling that credit in. It doesn't matter how good your investment is. You become a forced seller. That's the thing with banks, you see. That's the thing with banks, you see. One more time. That's the thing with banks, you see. They pull the rug when you most shouldn't be doing it. And that's how they get your asset at the best value price. So by giving you the leverage to get yourself into the trouble, they take it away to force you into being a seller at the very best price. It's part of the game, and they've been doing it for generations. Welcome. Now, your over-leveraged Dow Jones has got downside, tons of leverage, tons of margined retail investors, tons of institutions, net long, half of Israel that's been buying the security tech index, where they've been heavily involved and encouraged, making sure they get all your pictures of you playing on the internet, and of course Facebook, Apple, all of these places, and you will overperform to the downside here, in my opinion. How far might that be? I would only be able to guess. But the only game in town right now is to be a seller, to someday be a buyer of forced other sellers who think they are going to, wait for the term, hodl. Hodl, the Bitcoin term, might be coming to a couple of folk who eventually won't be able to hodl anymore when the pain gets too abrupt, because they don't think it can ever go that bad. Remember that at 19,900 Bitcoin to later trade 6,000? Kind of similar numbers. 19,900 to 6,000, 26,000 to 10 or 12? Who knows? It's possible, but that's a guess. Bear that in mind. But on balance of probabilities, I have a very high confidence that this is the beginning move. By the way, it gaps like a monster. Now that's a great start for a breakout. That does sometimes mean you can get a return move. Who knows? Maybe we'll be able to short tomorrow a little higher up. They try save it. Maybe you won't get the chance. I can't tell you what's going to happen in terms of that. But what I can say is, speaking of numbers and Bitcoin's numbers and the Dow's numbers, what's that secret society from Yale called again? Scratching my skull. Mainly bone. Yes, indeed. And what's that number on the door? 3. I can see it now. It's a bit misty, but I'm looking through the mist. 322. Dearie, what's the date today? You stupid fool, you never know the date. It's the 22nd of March, you idiot. 22nd of March. 322. On that day, I'm calling for you the big crash. The big crash. I don't think it's going to be the financial reset crash, although it could roll into that, but this is going to be a significant sell-off. Sell in May and go away, as they typically say. And if you are an over-steamy index, May might just come a little sooner. And by the way, they're going to sell you on the narrative. It's Trump what did it. It's these trade tariffs. It's this. No, it's the fact that it's hopelessly hyper overvaluated, and at some point there'll be a straw that breaks the camel back, and you can put that straw in a picture and parade it around the village and the city and say, here's the village idiot that broke the stock market. Or you can see the donkey that had 47 bales of straw and was asked to climb a mountain and died when you put that final piece on him. That's what you can see. So forget the narrative. This is a hyper evaluated index that was created by quantitative easing and the proliferation of money. The dollar that this represents in value today is not even the same dollar of the lows of 2008. So that's one of the reasons why it went up. The leverage that's been created for these people has been re-pumped up after taking it away, as the bankers play. Give it, take it away at the key moment, buy it all back yourself, inherit it all back yourself at the bottom of the market. So my take, US indices, big trouble. Will there be sympathy sell-offs in other nations? Yes. Who has the most froth? The US does. Who probably has the most leverage? By the way, CEOs, and I've been going on about this umpteen times for freaking ages, hitting options, having these, coming to the board and saying, set me a real far reach target, but then, I want to I want to be a billionaire out of the options that you're going to give me. But I'm going to, make it really difficult, like a super stretch target that I could never make. And oh yeah, the bank says we can borrow loads of our, we can extend our commercial mortgage. And I think we should do buybacks of our own stock because it's cheaper to pay 0.5, 0.75, couple of ticks on interest rate. By the way, we just happened to have an interest rate yesterday that's now pushing this over. It doesn't help when you give leverage to the monkeys to go long only, and then you make that leverage get expensive like. And guess what? When you're at 0.5, there's not much downside, and there's a whole bunch of upside to the price of that money that bank gave you. And everybody gets caught by it every single time. And now that rate ticks up, and supposedly there's going to be at least 3 more this year. Bullshit. But anyway, the stock crash will help create the environment that it's no longer conducive for aggressive interest rate rises. However, we will continue to monitor the situation. Yada yada, Fed speak. They're punks, they're jerks, it's a game, they're never going to take it to 6%. Go subscribe to my Reset Sniper channel and go watch the video of yesterday. Yes, on the spooky balcony at night. Yes, and watch what I had to say about that. Today, the stock crash. I am really peeved that I looked away and missed this one. I had saw that there was an inverted HVF falling and I got involved with a lot of other things. I should have been in this, but I'm in it now and I'm late. It slipped a little bit and I'm hoping actually that it rallies a little bit so I can get some more. Why? Overperformance, and I think this is going to be big. Guess what? You've got the summer season coming for the Northern Hemisphere. It's terrible. Sell in May, come back in St. Leger's Day, which is basically the autumn, this winter run, where you'll often get a Santa rally. And that's a lot of months for a lot of abysmal selling, and there's a lot of bad news and a lot of rot and a lot of debt that has to be owned up to, and that's all happening right here right now on your US stock market. And in a sense I feel a bit of glee. Why? Because it's unsustainable. It is unsustainable, it's criminal, it's banker driven, and we want it to end. And it could be the trigger, one of the first triggers in a large and very serious financial reset. And I'm afraid bringing it on is actually a good thing, because extending the zombie coma where we have no reality, we perpetuate a fantasy, simply isn't good enough. There's people whose pensions are going to be destroyed. There's people that are going to lose jobs. We actually need, when you have a hangover, it's best to get through it, not to keep drinking and hoping that you'll wake up and you won't have a hangover. What happens is you end up dying and going for a stomach pump. So sometimes you have to take the pain. There isn't such a thing as a no-pain economy. And if you continue to practice such drug-inducing markets, aka getting high on the coke, snorting and pumping the opiates so that you can go as high as a kite with leverage and all the other unsustainable gearing and trickery and chicanery that is being pulled, you end up biting the dust. So hear me now, this is going to be an unpleasant, strong sell-off on the Dow Jones. It will probably trickle through all US indices to varying degrees. The SMEs often get bad hurt. People will come back, blame it on Trump or the Facebook incident or spoiling the fangs, etc., etc. Not interested. It's been a hyper-valued, over-leveraged market for a long period, and whatever happens to be the narrative of the moment is just the straw that broke the donkey's back in my case. So that's my message to you. Hope you enjoyed the vid. Look forward to doing a technical one for Market Sniper. Haven't put out on Market Sniper for a while. This is a traditional market. It's not a crypto market. We still watch this, and we've been watching the FX as well, and there's one or two interesting little inverted setting up involving the dollar too. Wouldn't you love to be in our premium area of seeing what we got going there? Anyway, if you want to find out more, you go to themarketsniper.com, click getting started. It isn't for everyone. You've got to want to trade. You've got to be prepared to take risks. You've got to be prepared to understand and learn a method and cooperate in an awesome community of like-minded people that are all of a certain standard and made a substantial investment to advance their trading and wealth building in a reset economy. If that doesn't exactly meet you, please don't. Just enjoy the free YouTube, share them, and good luck to you all. I love you all regardless and hope you enjoy this. Watch out those US indices. Bye for now.